years old.
Yes.
Yeah. and Josh Allen is 28 years old. So hard for me to even think about somebody born in 1996 as 28 years old. But anyway, the point I'm getting to is I look at 2025 for the first time, right? I mean, the last time we got together on the show, it was 2024. I have a date. I have a year, and I know you do too, on our personal written financial plans of our year of financial independence. It just got closer.
It did. I actually have a countdown on my phone. Because every once in a while, I need that reality check of, okay, what am I doing today, right now? Even though this is what I do for a living, what am I doing today to make sure that I'm ready for retirement when I hit that marker? Not that I'm leaving that day, but that I want to be ready to retire.
Yeah, and that's my challenge for everybody to start this year. It's not a New Year's resolution, but if you don't know your year, your date of financial independence, this is the year to create it. And it is done by creating a written retirement income plan. It helps you discover, protect, and share true financial independence. It's what we do every day for our clients. If you ask one of our clients, find one on the street, you know one personally, they're going to know their year. If they're not already reaching it, they're going to know their year of financial independence.
Yeah, again, it is about financial independence, not necessarily the year they're going to retire, but the year that they could if they wanted to.
Yep. Lots of peace of mind that comes with that written retirement plan. So with that in mind, that's where our answering to the questions take place. That's our perspective on everything we talk about on today's show. So we're ready to dive in. Here we go. Question number 1 from Nate. He sent in a text message and asked us, what are your predictions for the economy for this upcoming year? Should I be concerned about anything in particular? Thanks for the question, Nate. And I would say yes, you should be concerned about being overly concerned about the economy. We're going to get into that.
Can we just put that on rewind and say that again?
Yes.
Yeah.
You should be concerned about being overly concerned about the economy. It is about your economy, not the economy. Now, it's not that the economy doesn't matter, but when I read this question, my first reaction is, where's our crystal ball? Right? Because we don't know.
I'll tell you, everybody's crystal ball is broken. It always has been, and it always will be. We like to say around here, even a broken clock is right twice a day.
Right.
So yes, there are people who've gotten some predictions right, but let's measure it against all the other ones that they didn't get right.
Yep.
And we want to be sure that our clients, our investors are ready regardless of what the economy brings, regardless of what your particular investments do in terms of performance. You have to be prepared regardless. So we don't want to lean too far into the economy's going to be great, the economy's going to be horrible. Be ready regardless.
Yeah, I think a great case in point, and we've brought it up on this show before, but if you go back to 2021 when inflation started to really ratchet up towards the back end of the year, and then interest rates soon followed, the Fed hiking interest rates, the predictions became pretty dire from America's leading economists. It was a very high percentage, almost 9 out of 10, I would say, that were saying a recession was imminent by 2022. The stock market responded to those predictions and went down in 2022. However, we did not officially have a recession. Those cries for a recession kept coming in 2022 and even into 2023. They have subsided now, and to this date, we didn't have that recession. So those predictions were wrong.
Yeah. So, Scott, let's look at some of the data that we have currently on where we are with the economy. Consumer spending is healthy. That's always a good thing. I don't know about when you did Christmas shopping, but when I did Christmas shopping, I was not in the store alone. There were quite a few people out doing all of that. So consumer spending is healthy. Unemployment rate is low, and corporations are profitable. And those are all good signs for where we are currently.
Yeah, the unemployment rate has ticked up slightly, but it is still historically very low. Hard to have a recession with an unemployment rate as low as we have. On the other side, even though the inflation rate has gotten a lot closer to the Fed's preferred 2% annual target, it is the cumulative effect of inflation that has certainly continued to hurt many middle-class, working-class Americans. Interest rates are still elevated, but they are starting to come down. And compared to the overall long-term interest rates in the United States, they're still relatively average. They're only elevated if you compare to the recent past. So I think the overall status of the economy is good. We don't see a recession coming in the immediate future, but it doesn't mean something doesn't happen to cause it. There's always a black swan event that could potentially be out there. There is legislative risk coming, or potentially legislative changes coming with a new presidency. Donald Trump will take office later this month, or be inaugurated later this month. He, of course, has talked a lot about tariffs, right? And I think that's depending on how you look at that, and maybe where your political persuasions are, depends on what you think about that. But I did want to kind of throw this in there. We had some info from a recent LPL research blog that I thought was great because it is backed by data, right? A lot of this can be pushed by feelings. Tariffs are good or tariffs are bad. The reality, though, a tariff, let's define what it is. First of all, it is a tax on the customs value of an imported product. So there's a lot of debate over there about, from the political minds and from the economic minds, of what would tariffs do? Well, the reality is tariffs are already in place. That's the one thing that we need to point out. During Trump's first presidency, he granted, or he put into force a lot of tariffs. He did grant exclusions for over 2,200 products included in those tariffs, though. And President Biden kept most of them. And he also put additional tariffs in place as recently as May of 2024. So there are still tariffs in place. I know that President-elect Donald Trump is expected to increase that. So what would it do? There is this worry that it would put some inflation pressure on consumer prices because it would get passed along. But the reality is that we can look at the data, and really is pretty much what LPL research calls a more neutral effect on the economy, because if you look at the tariffs imposed in early 2018, it impacted producer prices more than consumer prices. So basically, in essence, wholesalers did not pass along fully the cost of importing due to tariffs. So that is some good news that it might potentially not be an inflationary risk. But I know that's something that, remains to be seen on how all the details of that work out. But I did want to throw that out there because I know that's something that people are concerned about. But the so what here is we return to Nate's question, your predictions about the economy. We can talk about that. And I think it's important to talk about it. I think it's important to know where things stand and potentially make small tactical moves inside of your investment portfolios based on where we think the economy is headed. But to go all in on those beliefs or go all out on those beliefs is really wrong-headed. It is about, as we mentioned earlier, your economy, not the economy.
Yeah, and I think that's where you've got to look at what choices can you make to be sure that you're putting yourself in a situation where if we do have, more inflation, you have higher cost of living, then what do you do about it? So I was talking, Scott, with a friend of mine recently, and he's kind of moving forward financially more so than what he's been able to in the past, and he was telling me that by getting some of these things paid off that have just been like an albatross around his neck for so long, at this point when he gets those paid off, he's going to have $700 a month freed up that he has had obligated to pay those debts in the past. And when you think about $700 now, if gas goes up, if milk goes up, all of these things that you have to consume on a regular basis, if those items go up, he has more than enough extra left in his cash flow each month now compared to what he has had in the past, and all because he got really focused on eliminating some debt. So if you think through, in your situation, Nate, what can you do? Can you eliminate some debt? Can you raise your income? Are you able to put yourself in a position to add to your retirement savings, to maybe even accelerate that timeline for retirement, or at least give yourself more income for retirement? So lots of things that I think are personal to you, and we don't know the details about your situation, about where you need to focus right now, but take the opportunity to think about, what can I do to move myself forward in 2025?
It's like at the top of the show, and we said, determine your year of financial independence. When do you want it to be, Nate? And then create a plan through contributions and investments to get your asset level where it needs to be to provide you the monthly income you want and need in retirement. The psychological effect can be really the most damaging piece to this if you let your concerns about what might happen in the economy overshadow where you are on your journey to financial independence. When we say it's about your economy, not the economy, it's another way from an investment perspective of saying control what you can control. And I would throw in there to wrap up, watch less news, because that can affect you psychologically and get you into apocalyptic thinking that can really damage your long-term financial goals. Thanks for the question. Next up, it's Chip from Maumelle. I'm 47 and thinking about starting a business and becoming my own boss. What are some key strategies for business owners that you'd recommend for me to not fall behind in retirement planning while I pursue my dreams? I'm going to hand off to the business owner right now.
Wow. If I had known years ago, 20 years ago when we started GenWealth, what I know now, there are a lot of things that I would have done differently, but I'll also say it all worked out. But one of the first things when we saw this question, Scott, you'll remember my first response was just immediate and almost guttural. Have more cash reserves than you think you're going to need, because I don't know if this business is just you or you and some employees. But it is extraordinarily hard to get revenue started from any new business early on. That's just part of it. And so if you think you're going to need 2 months worth, you need to make an effort to have 4 or 5 months worth of income set aside just to cover, on top of your normal emergency fund, just to cover those expenses that the business might have during that period of time. A lot of times when people are starting their own business, they don't necessarily have a physical location, so maybe you're not on the line for a rent payment. We were in those early days as well, and that was a big deal to make sure that as well as a small number of team members, that we were able to cover for them. And to be very transparent, there were days early on where we did not pay ourselves, and we had to be okay with that. So I think just be very prepared from a cash perspective. That being said, if at all possible, I would discourage you from using whatever retirement savings you already have as your cash resource. It might be there, it might look like it's easy, but not only are you withdrawing, X amount of money, let's say you withdraw $50,000. Well, you're going to have the taxes on that $50,000, and because you're not 59 and a half, you're going to also have a 10% penalty on that $50,000. And one of the biggest things, Scott, that we don't usually even talk about is the lost earning potential. At 47, you might be 20 years out from retirement. So what looks like $50,000 has multiple doubling periods for you between now and retirement. That might be a $60,000 or $80,000 or even more withdrawal from your retirement just to take $20,000 out now. So just be careful. And I changed figures on the examples there with you several times, talking about 50,000, and then I randomly said 20,000. But you get the point. If you're withdrawing money now, there is a significant impact on your retirement 20 years down the road.
I think about the planning phase of this too. When he says he's thinking about it, where are you in the planning process?
Yeah.
Do you have a business plan? And do you know how disruptive the change could be? We don't know about your current employment situation, but certainly if you're working for someone, and it sounds like he is because he wants to become his own boss, which we can talk about that a little bit later on becoming your own boss.
Yes.
Your clients become your boss, right?
That's right. You
still have a boss. But I think the disruptive nature of this in terms of how long will it take to match your current income, because that's the disruptive part, right? If you're used to living on your salary and maybe a spouse's income as well, and you erase one or both of those to go into business for yourself, when is the cash flow or the profit going to match your current income, or at least get close enough that your lifestyle doesn't change and your retirement contributions, if you're currently making them, doesn't change? Do you have customers already lined up? Is there income that's going to start from day one, or is it going to take some time?
Scott, circling back to matching that current income, I'll draw a parallel here with what we often do with people who are getting ready to retire. When somebody comes in and says, "Oh, I'll be fine on 80% of our current income, we can retire and we'll be okay with that. We actually have them test that, because I know people say all the time, you'll find that in studies, you can live on 80% of your income. What they're really talking about is more related to your gross income, because you've been contributing maybe to a 401k, etc. We're talking about net income, and I don't know very many people who can make it on 20% less net income and maintain their current standard of living. So whatever your objective is in terms of income, what you think you're going to be living on for those first few months or however long, you and your spouse, if you're married, you need to go ahead and test that before you pull the trigger on this.
If you've listened to this show for long or watched, you know that we haven't always been financial advisors. So this next story comes from pre-financial advisor Scott. I built it, and this is not being a business owner, but I built my own home years ago with my wife, and we contracted it ourselves, and we did a lot of work ourselves, but we really bit off more than we could chew, and our mortgage payment at the end of that house building project ended up being quite a bit more than we had bargained for, than we had budgeted for. And for a time, until interest rates went down and I was able to refinance, I did back off of my retirement contributions through my employer at work, because I had squeezed my margin. And that wasn't a fatal mistake. I've overcome that, but I had to work harder, right? Because it really didn't happen for very long. In fact, it was about 3 years, right? Mm-hmm. You don't think about that being a big deal, but as now financial advisor Scott put that hat back on, I can see if I wouldn't have backed off of those 3 years of contributions, how much farther ahead I would have been on my path to financial independence. And I know that business owners, if you have an entrepreneurial mindset, and Janet can attest to this, you think about building the business up as a piece of that financial independence, and that's perfectly fine. But I just would encourage you to not back off of the retirement contributions, and you don't have to as a business owner, because there are some great options for you.
Well, and along the lines of, investing in the business as your future retirement source, especially at GenWealth with the type of business that we own here, everything we have touches the market. Right. The business is market related. Our personal investments are market related. And so we as owners have been focused on having some diversification outside of that. And I would say, not at the time that you're starting the business, because you need to be all in on being sure that you give this every effort you possibly can, because frankly, a lot of businesses don't make it. They don't make it long term. So give it everything you can. And then when you get to a point where you can raise your head up and go, okay, now what? Be sure that you build in some layers of diversification for your retirement planning. And in your case, that's probably looking at retirement plans. When you get where the business is stable enough for you to be able to set that up, and it might be just you. And in that case, we would look at doing a SEP IRA, that type of thing for you. I'll let Scott go into more of those details, but I do want to take a moment, just business owner to potential future business owner, to encourage you, at least for me, it was worth it. Chip, there were some long, hard days, and for a long period of time, to be very transparent, to get everything up and going. People talk about it being an overnight success. Well, here we are, 20 years into our quote unquote overnight success. It will look like it's a short time to everybody else. To you, it will feel like forever. But I will absolutely, unequivocally say I don't regret it for a moment. It was hands down a great move for me and for our family, and frankly for our team as well. It's been good for everybody involved, and that includes our clients. But you've got to be sure that this is going to check the boxes for you as well.
I think in the interest of time, we probably can't get into the details of these, but I do want to encourage you to reach out to a financial advisor and find out some information about these retirement plans. There is something called a SEP IRA for business owners, a solo 401k. There's also for higher earners a defined benefit plan, and a simple IRA if you have employees. So depending on the structure of your business, how it's set up, whether you're going to have multiple employees or it's just going to be you and maybe a spouse, one of those might be a good option for you to be able to continue to make retirement contributions. And I would encourage you again to talk to a financial advisor to talk through the specifics of those. And we can do that here at GenWealth. For you or any other business owner listening today, you can call toll-free 866-653-PLAN, 866-653-7526, and we can talk that over with one of our financial advisors. Chip, you're the question of the week. We're going to give you a free Get Ready for the Future Show tumbler for being named the question of the week. Just reach out via email to claim it, show@getreadyforthefuture.com. Next, it's April from Little Rock. How do I know when to take Social Security? I don't want to lose out on money if the trust fund runs out, and I delayed taking it instead of going ahead and getting what I can. A lot of talk about that recently. Really, every year it gets talked about. And I think it's a common question in our meeting rooms, too, when we start addressing Social Security in the planning process with our clients. So let's talk about that and where we stand. First, what is the trust fund? Well, the trust fund is the emergency fund for Social Security, right? It's the extras. It is the money that is not needed today to pay out current benefits. Well, it is projected to be depleted in the next decade. In fact, as we sit here early 2025, the most recent report, which comes out from the Social Security Administration in April, says it's going to be 2034. So it's less than a decade now. And that varies, but it doesn't vary more than a couple of years one way or the other every time that annual report comes out. So what would that mean? If the trust fund is depleted, it just means the extras are gone. It doesn't mean Social Security is bankrupt, because taxpayers are paying a Social Security tax every time they get a paycheck, and that money goes in and then it goes out to recipients. But it's going to be running at a deficit if the trust fund runs out. So what would have to happen is the Social Security Administration projects that benefits would be reduced across the board by up to 23%. So if that cut is made, it's likely projected to be enough for Social Security to survive through the rest of the century. So if you think about a worst-case scenario here, Social Security is not going away because it, by law, has to continue. If benefits have to be cut, you could expect to still get a good portion of your benefit. But to April's point, does it make sense to take it early if that's going to happen? And I think if this is the worst-case scenario, let's talk about the likely scenario. There are a lot of levers that Congress can pull here to preserve the trust fund for at least a little while longer. And by a little while, I mean decades, probably the rest of April's life. You could raise Social Security taxes. You could raise the retirement age. You know, it hasn't been raised in a long, long time. Everyone born 1960 or later, your full retirement age is 67. Nobody's is higher than that. We've got people on our team here, and I use this in a client meeting room. Brandon is sitting there, Brandon Barber, who's our associate advisor, and he's about 24 years old. And I say, Brandon may be 80 before he can take his Social Security benefit, but it's okay because he's going to live to 130, right? So it is a possibility to raise the retirement age. The very unpopular one would be means testing, which basically would say, hey, they look at your assets and say you have enough money, you don't need Social Security, or you don't need all of your Social Security benefit. Could be a combination of all three, but the point here is none of these are politically popular, and that's why we haven't done anything yet.
Yeah, that's absolutely the case. And I go back just about every time this topic comes up, I go back to a Winston Churchill quote. He wasn't saying this about Social Security, but I think that it very easily applies. He said, you can always count on Americans to do the right thing after exhausting all other possibilities. And I think that at the end of the day, that's what Congress is going to do. They're going to look at every possibility, and really the key for any congressman, they want to be reelected. So they're not whoever's in office in 2034 and before that. They're not going to let this just go by the wayside and we don't have any money left over to pay out 100% of the benefits. There's no way they're going to do that because they would never get reelected. Yeah. So we do have faith that given time, that they will do something to expand the life of this. A lot of the things that Scott talked about have been in discussion for quite some time, but I think that they will exhaust a lot of time before they get to that decision point. But another thing that I would encourage April to do, though, is to really think about regardless of how you feel about the viability of the trust fund, to think about a claiming strategy that is unique to you. There are so many different ways to claim your Social Security benefit, and it's key to understand that the Social Security Administration is not allowed to give financial advice. So you get a statement, and if you're married, your spouse gets a statement, and those two are not looked at together by the Social Security Administration. It's a his and a hers. Now, can you get that information about spousal benefits? Absolutely. But there's never a time when the administration sends out information to say, and by the way, there's these 80 plus different ways that one could claim Social Security, and here's the one that we think is best for you. They cannot do that. And so it's really important for you to understand what your opportunities are. Are you married? Have you been married in the past? Maybe you're widowed, maybe you're divorced. What is your retirement age going to be? Lots of variables come into play, and that needs to be taken into account. And really, again, if there's another person involved, whether it's an ex-spouse or a current spouse, we really need to solve for what are all the possibilities and what is best for your household income.
Bottom line, we shouldn't make our Social Security decision in a vacuum. It should be made in conjunction with an overall retirement income plan, which incorporates all potential sources of income along with retirement savings to build a monthly income stream that doesn't run out for the rest of your life. We do want to offer you, April, and anyone else listening, because part of our overall planning process at GenWealth includes Social Security analysis. And we're going to have a special offer because we know people are trying to make those Social Security decisions. We're going to offer a free Social Security analysis if you contact us by the end of January. So if you want to go through a Social Security analysis, you're coming up on retirement, trying to make some decisions about when to take it, contact us by the end of January. We'll give you a free analysis. You can do that by emailing us. Send it to show@getreadyforthefuture.com or call us toll-free at 866-653-PLAN. That's 866-653-7526. Our final question of the day comes from Raymond via email. I recently reached $1 million across my investments. What's the next step for me? That's great, Raymond. $1 million is a great milestone. It's a mental hurdle that you can really get behind and get excited about. But there is nothing magical, really, about that number. And I think we've made it that in the marketing side of the financial services industry. Yeah. Hey, if you have $1 million, do this. Here are the 7 steps you must make. It's nothing inherent. If you go in and read those things, everybody really should be doing them. Everybody needs to do them. Yes. Yeah. So the $1 million is not magical, but I do think it means that it is definitely time, if you haven't already, to get a plan together on paper, on purpose.
Absolutely. I think one of the keys that I would want to be sure that you understand is that it does not mean that you're financially independent. You might be. We've seen people with $1 million who were financially independent. We've also seen people with $300,000 who were financially independent. It all depends on what your obligations are and what your income resources are. So lots of things to consider there. I just think Scott and I would both encourage you to not feel like you have arrived and this is it. Maybe you have, but it's important to understand what your situation is. So how old are you? When do you plan to retire? Those are going to be factors that come into play in determining what your financial independence really looks like. And we don't really know that without a plan. What are you going to need in terms of retirement income, and how much retirement income are you going to want on top of covering your basic needs?
Yeah, and I think on a risk tolerance level, from an investment perspective, it is certainly now to the point where you have a big market correction and you're going to feel it if you are all in equity, right? A 10% drop in the market is going to look a lot different on $1 million than it is on $100,000. So diversification, not just for the sake of diversifying, but diversification matters here so that you start to begin to protect at least a portion of that $1 million. How much gets allocated to a diverse strategy or something from an asset class perspective that's different than stocks, that is determined also through the planning process. Because if you think about our bucketing strategy here, Janet, if you have $1 million at 45, there's going to be a different strategy in place investment-wise than if you have $1 million at 55 or 65,
Sure.
because it depends on the time horizon when you're going to need to utilize a portion of your assets as income. And so that goes back to what you've already said. When are you going to retire? How old are you? That's the thing that needs to be determined to answer Raymond's question about what's the next step.
I think another key thing, Raymond, for you to consider is tax diversification. We don't really know. You say you have this across your investments. We don't know if that's all pre-tax, if it's some combination of pre and post-tax. If there's an opportunity maybe for some Roth conversions, and I always want to underscore this, don't go overboard on Roth conversions, because you have to be able to pay those taxes out of pocket on whatever amount you're converting. So be careful about that, but it is something that we would want to check the box on. We've talked about it. We've determined together whether this is a good move in your situation or not. So definitely something to look at. And then also, do you have anything in non-qualified investments? So it doesn't qualify for any special tax treatment whatsoever. So we would need to understand that. And then, are you maxed out in what you're doing as far as your contributions towards your retirement? Again, that kind of depends on your age. If you're over 50, you can contribute more than normal, and that might allow you to be able to accelerate your already planned retirement timeline.
The final piece to that, as we begin to run out of time here, is the estate planning concept there too. Raymond, if you've reached $1 million, you need to start thinking about where is it going to go? What's going to happen to it after I'm gone? And estate planning can help you do that. At GenWealth, we can help you do that. We help clients access and guide them through the estate planning process as part of the GenWealth Ready to Retire process. So couple of things there to think about, Raymond, as you've reached $1 million in assets, and for anybody else that's reached that as well. You heard the bell in the background. Time for our final thoughts.
I'm going to focus a little bit on the GenWealth difference. We are, as you have probably heard us say over the years, we're education-driven, strategy-based, and team-delivered. And towards the end of 2024, I mentioned something about this, but I really think it's so important for everybody to catch. In 2025, we are having lots of educational opportunities available for you, our listeners, at no cost. So be sure that you check out getreadyforthefuture.com/academy. We are regularly having GenWealth Academy workshops so that you can learn more about retirement investments and your money.
My final thought, I'm going to give you two. Go back to the beginning of our show. As a new year comes, 2025, I would encourage you to find out what is your year of financial independence. Set it and make a plan to achieve it. We can help you do that. And we want to provide education all along the way. That is why we do this show, the Get Ready for the Future show. We have lots of resources. Janet alluded to the workshops you can find at the website. There's also some free downloads on the website. And then I know a lot of you listen to the Get Ready for the Future show on the audio version only, whether it's on the radio or it's on podcast, and you had no idea that we have a YouTube channel. We want to invite you to subscribe to it. Subscribe to our YouTube channel and get exclusive content you can't find anywhere else to help you discover, protect, and share true financial independence. And you can subscribe to it by just going to YouTube and searching for GenWealth Financial Advisors. I invite you to do that today. That's all the time we have for this week's show. Thanks for listening, watching, however you get the show. We're glad to have you. And remember, you can always ask a question by calling and leaving a voicemail or shooting a text to 501-381-5228. We'll answer more of your questions next time.
The GenWealth Financial Team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.